and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and today is Education Monday. In light of the market holiday, because of Martin Luther King Day, we're going to actually discuss a very important topic. We're going to discuss the rules on rolling a covered call. Now, I say it's important because as we get into 2025, one of my favorite strategies to talk about if I want to get bullish on a fairly expensive underlying stock is called the fig leaf, otherwise known as a leveraged covered call. Inside the Options Playbook, I call it a fig leaf, and I'll discuss a little bit more today on why or where that name came from. But the biggest thing about a leveraged covered call is that you really do not want to be assigned on your option contract. So understanding how to roll an option contract is very important to avoid assignment. So today we'll talk about some of the rules on how to roll that. And in order to do that, I'm actually going to use my website, optionsplaybook.com, and we're going to go to the management section and talk about rolling. So let's do that at this point in time. Let's go to the Options Playbook website. And I want to highlight where you can find this section. So if you go to the homepage, optionsplaybook.com, you'll see a tab that says resources. If you click down on the resources, you see managing positions. You open up that carrot and then you see all the different rolling strategies. And today we're focusing on rolling a covered call. So we have a generic example inside the Options Playbook, or I should say I have. And let's go through that example. And then I'm going to go and run over to the Tradier Pro software. And we're going to use this Apple stock and go through a real example using a real stock. But let's get through the dynamics of just what it takes to roll a covered call. All right, so here's our situation. We have a 30-day call option on stock XYZ. So we're talking about a fictitious stock. The stock is at a $90 price point, and this means you own 100 shares of XYZ stock. So don't forget that if you're doing a covered call, it's only covered if you own 100 shares of the underlying stock. Now, once you've sold that call, you have a 90-day strike, a 90 strike call that's a month away from expiration. Hence, we say 30 days. So when you've sold the call, the price was at $87.50. You received a premium of $1.30. Everything sounds fair, right? You have the stock at $87.50, XYZ. You look at the 90 strike call. You go out 30 days. You get paid $1.30 for saying that you will give up your stock at $90. And if the stock goes up above $90, they can call the stock away from you. That is a covered call. Now, with the expiration is fast approaching, the stock has gone up to 92. You'll probably be assigned, and you'll have to sell the stock at 90. You did not want to sell the stock. You wanted to try to avoid the assignment. Now, biggest thing, what are the odds of you getting assigned? Well, early assignment, which is also under the resources tab, and I can actually point that out again. What is early exercise and assignment? Doesn't happen that often, especially on the call side of things. And I have a very quick explanation as to why, in that if you exercise a call option, you spend cash now, right? So the stock runs through your strike, gets to 92, and you say, okay, go ahead and call my stock away. Maybe you want it called away. Maybe you want to sell it at 90. Well, on the other side of the coin, the person that owns that option contract that has the right to buy the stock at 90 is saying, well, I know I can buy it at 90. I know the stock is at 92. There's a benefit there. But if I exercise now, I'm spending cash now. Or I can wait until that expiration date and I can spend cash later. I know I'm going to get it at 90 no matter what. So if I really want to own the stock, there's no concern here because I have the right to buy the stock at 90. So do I want to exercise now and pay cash now? Or do I want to exercise later and pay cash later? Most of the time, people want to pay cash later. And on top of it, gosh, you would really look silly if the stock actually, by that expiration date a couple of weeks from now, was now trading at 89. And you're like, well, wow, geez, I wanted to own the stock, but now I ended up exercising early and I actually paid more for the stock than if I would have just rode it all the way to expiration and noted that the stock actually went down in price and I could have bought it lower. So on moral of the story is that if you sell a call against a position that you have, in this example, XYZ 100 shares of stock, the odds of getting exercised early on a call option are minimal. Now, if you want to learn more about that, please go to that section that I just showed inside the Options Playbook. There are a few exceptions to that rule. All right, so if expiration is fast approaching, here's the way that you want to roll, and here are just the mechanics of it, okay? So existing position, you have a 30-day 90-strike call option. You received $1.30 for it. Premium paid to close the 90-strike call. So you go out and you look at it and you see that, okay, I paid $1.30 for it. Well, in order to close it, now that the stock has moved against me, I have to pay $2.10. You say, gee, that kind of stinks a little bit, right? I've lost money on my call option. I received $1.30. I have to pay $2.10 to close it. That means I'm down 80 cents on the trade. So what a lot of people will then try to do is they'll take the night, they'll go out in time and go out further in time. So you're adding premium to your option contract because time is money. So we're going to go out further and we're going to look at a 60-day option contract. And we're going to go up in strike because we don't want to be assigned. The stock's already above 90. So we're going to sell the 95 strike call. And that call happens to be trading for $2.30. So most of the time when you're rolling an option contract, you do not want to pay for that option contract, right? We're sellers of options, not buyers. So ideally, we want to go up and out far enough that we can receive a net credit. And in this instance, we can. In our fictitious instance, stock was at 130. We paid $2.10. We received $2.30 for it. So you want to concentrate on this block right here. That means we bring in a net credit of 20 cents to the account. And we have freedom of reign in XYZ stock until it hits 95. Now, a lot of people look at this and they kind of think of it as if you're on a gambling table and you're playing blackjack, if you just keep losing, if you eventually keep doubling down, you're going to at least break even on your blackjack betting, because ultimately you're eventually going to win. So the concept is that if you just keep doubling down, ultimately you're going to get your money back, which that's a real hard thing to do at a cards table. But in here, this is kind of what you're doing. So every time you're rolling up and out, be aware you are losing money on the option contract that you're rolling. If you're closing this, we're losing 80 cents on this trade. Now we just need the stock to stay below 95, and this credit can offset that loss. But be aware that stock could go down in that instance. So this isn't always the most ideal solution. And if the stock goes down, you could lose money on the stock going down as opposed to just letting it be assigned at that strike price. And on top of it, you are locking in that loss on that short option contract. All right. So the concept still works, and a lot of people like to do it if they want to avoid assignment. And I'm going to talk a little bit more about the leverage covered call here. So what are some of the rules of doing this? Well, one of the biggest rules to me is to roll early. You need to have as little intrinsic value on your option contract as possible. In our instance, we said that the stock, the 90 strike call became in the money by 2 points, and it was trading for $2.10. It had 2 points of intrinsic value because the underlying stock ran to 92. All right. Now, it does depend on the underlying and how volatile the underlying is. The more volatility, the more premium there is in the option contract. But you usually want to be about 1 or 2% in the money, no more than that. And if it gets to be close to those levels, you want to think about rolling. Or you can do a preemptive roll. In other words, the stock is at 89. If I roll at that point in time, it's going to be easier to roll up in strike and out in time. If you end up getting 4 or 5% in the money, or in this example, let's say the stock goes to 94 or 95, now you have a whole lot of intrinsic value in the option contract, and time premium starts to dry up. In other words, the option contract's going to trade, if the stock's at 94, it's got to trade for at least $4, right? And if you're going to try to go up and out, you're really not going to have enough time premium. You're going to have to go way out in time in order to get the trade done for a net credit to the account. So go back to the first statement. We're not option buyers. We're option sellers. That's what covered call people are, or investors, I guess, if you want to make a little bit more accurate term. In that instance, you need to really consider, do you just want the stock to be called away? Or do I really want to go way out in time to make up for the fact that I let this option contract get so far in the money? So it's not as much about the time. Let's say I put the trade on, there was 30 days to expiration, 2 days go away, got 28 days left, and the stock reaches 90. So you say, I don't want to roll at this point. You got to roll. You can't let that option contract get in the money if you're going to try to avoid assignment. So the stock ran quickly still means you're still more concerned about how deep it gets in the money as opposed to the time premium that's left in the option contract. So that's an important, and that's kind of rule number one, that you need to be active if you're looking to roll to avoid assignment. And this is fairly important if I'm going in, and let's back out and let's actually just look at a real example so that I can try to show you this. So let's run over to the Tradier Pro software, and I'm going to pull up an options grid. Now, these are live markets. They won't be live when you're viewing this because the markets are closed and we're taping this a little bit early. But here's where Apple is trading right now at 237.84. So a lot of people own Apple, and one of the things is earnings is happening. But let's pretend that we just have 2 days remaining to expiration, and we went out and sold the 237.50 call, right? The stock right now is at 237.81. So we're in danger of being assigned. We have 2 days remaining to expiration. We just got in the money on this option contract. We see that it's trading for a real premium still, and I don't really care what I initially sold it for. It's just all about what it's trading for right now. So on the ask price, the ask of this on this call position is $1.90. Now, ideally, if I'm rolling, I don't want to go out farther in time. I want to go very short, right? I was hoping that contract expired worthless and it didn't reach the strike, and now it just did. So this is a 2-day option contract, January 17th. Let's hopefully go out to the January 9th contract and see if we can roll up and out in time and come up with enough premium to avoid the assignment on the shorter term option. All right. So if we look at the January 24th expiration, 9 days away, we see that the 240 strike call is trading for $2. So here's what would be the trade. We would come in on this scenario and we would be buying to close that option contract. And then in this scenario, we would be selling to open this option contract. Now, in this scenario here, what we have is a 10-cent net credit to the account, and I don't mind that at all. It gives my stock a little bit of room to run all the way up to the 240 level here, 2.5 points, or a little bit less than 2.5 points higher. But I can go out only 7 days, and I can bring in a net credit to the account. And all I'm really trying to do is avoid assignment. So the trade would be, if we're looking at this would be a buy to close. Buy to close is what you would click on. It won't let me do that because this is I don't have this position in on my account. And then we'd be selling to open, and we'd be doing this for a net credit to the account. Now, let's go back to the other scenario, and let's go back to the January position. All right. And here's what I'm talking about if you're not all over your option trading. when the stock hits that strike. So let's say we didn't sell the 237.50, $237.50 strike call. Let's say we sold the 235 strike call. It's only 2.5 points more in the money, right? Well, if we look at this, we are then paying for this option contract $3.70 for that contract. All right, so now this is the one that we need to buy to close because we're short that contract. But we got to pay for all that intrinsic value, and there's still some time value left in that trade. So let's click on that. And then let's go to the January 24th expiration. And you'll note that there's really no option contract that we can sell. The 240 is trading for 2, the 242, the 250 is 18 cents. So what would we have to do? We'd have to go out further in time. And we'd have to either go out to the 16-day option contract, the 23-day, or even the 30-day to get to a point where we could sell the 240 or the 242.50 strike and be able to pay for this option contract that is 2.5 points in the money. So here's a great example that if you snoozed on your option contract and all of a sudden you're a couple more points in the money, in that instance with this very short time frame, talking about a 2-day and a 7-day, it's very hard to find an option contract that you can roll to and get it done for a net credit. But this is a very feasible roll in that if I had the 237.50 strike, it gets to that strike, I say to myself, all right, Brian said you need to be very preemptive on these rolls. And once it hits your strike, you got to consider rolling right away. If it gets a couple of points in the money, it's still feasible, but you're going to have to go out a little bit further in time. But in this instance, I can buy to close that option contract and go up to the next strike, and I can sell to open that option contract and get this done for a net credit of around 10 cents to the account. All right. Now, this stock is also, they're announcing earnings, and most of the companies are announcing earnings at this point in time. So it's kind of hard to find one if you're talking about rolling option contracts, but this is also the case with ETFs, SPY index, the IWM index, which is the Russell 2000 ETF. All of these scenarios, if the stock gets close to your strike price, you need to think about rolling at that point in time, or be ready to just give up your underlying and let them call the stock away. Now let's run back out for one more second, and I'm going to highlight the one strategy where this is a real important concept. And that concept is in the fig leaf strategy. So, all right, now we're in the fig leaf inside the options playbook. Let's check it out. Okay, so with the fig leaf, what we're doing is we're buying a deep in the money call option as a substitute for owning the stock. And here's where the name the fig leaf comes from. And I actually highlight this inside the book, is this tells you a little bit about the name. But what you're thinking here, and why I named it the fig leaf, is that you're kind of covered, right? You aren't covered as far as the brokerage firm is concerned. You're buying a deep in the money call option. You have the right to buy the stock at a lower price than where it's currently trading. And then you're selling a shorter term out of the money option contract. And that means that if the stock gets up to that level, they can call it away. But the problem here is that if they call it away, you don't own stock. You own something that gives you the right to buy the stock. And that creates an issue, especially when you're dealing with different expiration. So we're going out far in time, buying a deep in the money option contract that has a high delta that is that you're hoping to be a surrogate for actually owning the stock, and then selling a shorter term option against it. And if the stock on the shorter term basis runs up and goes above the strike price, you might be in danger of getting assigned. All right, so don't panic. First of all, you just want to be preemptive with your roll. Don't let that option contract get in the money if you can avoid it. Or if it's just in the money, think about rolling at that point in time. And then if you are assigned, you don't want to exercise the deep in the money call option. Usually, depending on where it is on the expiration cycle, how many days left it has to expiration, usually you want to sell that option contract, capture as much time premium as possible, and then actually buy the stock and deliver that for the assignment. And that's okay. Your brokerage firm will allow you to do that. If you get an assignment notice on a covered call, as long as you buy the stock the next day, you're going to be okay in that scenario. But bottom line is, if you're doing this type of strategy, understanding how to roll a call option that you are short on is a very important concept, and hence the name the fig leaf, meaning that we're kind of covered. We have the right to buy the stock at a lower price, but we don't own the stock. So this concept is homework if you ever want to do a fig leaf trade, otherwise known as a leverage covered call. And that's it for Options Guy TV for this Monday, Martin Luther King Day, January 20th. Thanks for tuning in, and we'll see you this coming Wednesday at 11 a.m. Eastern Time inside the Tradier Hub, hub.tradier.com, for the next edition of Options Guy TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.